Have you decided that you want to invest in the stock market but are unsure how to get started? When it comes to building money, investing in stocks can be a great method, but it is not without its potential difficulties. Choosing the appropriate stocks, avoiding frequent traps, and maintaining a commitment for the long haul are just some of the many things that need to be taken into consideration. In this video, we will break down the important stages that every novice has to take to start their investment journey with confidence. This will assist you in constructing a strong foundation for achievement in the financial world. How about we get started? Number 1. Invest in the appropriate investment. When it comes to purchasing stocks, it is easier to say than to accomplish. Even though it is not difficult to recognize a stock that has performed well in the past, it is significantly more difficult to forecast how it will perform in the future. If you want to be successful in investing in individual stocks, you need to conduct a comprehensive analysis of the fundamentals of the firm. In this context, indicators such as earnings per share, EPS, and price-to-earnings ratios (PE) are taken into consideration here. In addition to this, it is of the utmost importance to analyze the management team of the firm, as well as its competitive advantages and the company's financial health using balance sheets and income statements. When you start looking at statistics, you have to remember that the professionals are looking at each of those companies with much more rigor than you can probably do as an individual, so it's a very difficult game for the individual to win over time, says Dan Keedy, CFP, Chief Financial Planning Strategist at TIAA. It's a very difficult game for the individual to win over time. Number 2. Avoid individual stocks if you are just starting in the stock market. A great number of individuals brag about their excellent stock selections, but they frequently fail to take into account the investments that did not perform well. Keedy says, what they forget about is that often they're not talking about those particular investments that they also own that worked very, very poorly over time. This is something that they neglect to mention. A detailed awareness of market patterns and company characteristics is required to successfully invest in individual companies. It is essential to appreciate that investing in individual stocks requires more than just luck. For every person who sells a stock, there is another person who buys it, believing that it will increase in value in the future. Tony Madsen, a certified financial planner and the founder of New Leaf Financial Guidance in Redwood Falls, Minnesota, says that there are tons of smart people doing this for a living, and that the likelihood of you outperforming that is not very good if you are a rookie. Number 3. Develop a portfolio that is diversified. When it comes to risk management and increasing returns, diversification is essential. Both exchange-traded funds, ETFs, and index funds offer built-in diversity by including a large variety of equities from a variety of industries in their portfolios. An example of this would be a fund that is based on the S&P 500 and includes stocks from hundreds of different companies operating in a variety of industries. By diversifying your holdings, you lessen the likelihood that a single stock will have a detrimental effect on your whole portfolio. The procedure is made easier by investing in exchange-traded funds ETFs or mutual funds instead of individual stocks, because these products already provide diversification without the requirement for individual stock analysis. Fourth, you should always be ready for a downturn. It might be difficult for many investors to deal with the volatility and losses that occur in investments. The stock market is fundamentally volatile, and it is unavoidable that it will experience declines. To be emotionally ready to survive these changes, it is essential to avoid making rash judgments based on short-term market movements and to be emotionally prepared to bear them. The impact of a single stock's bad performance can be mitigated by diversifying your portfolio. Nonetheless, even index funds will undergo volatility in response to market conditions. According to Madsen, whenever there is a change in the market, there is a tendency for us to want to pull back or to question whether or not we are willing to go with our investment. To maintain your path and achieve long-term returns, it is vital to prepare yourself for periods of declining performance. The fifth piece of advice is to use a stock market simulator before you ever invest real money. Employing a stock market simulator can prove to be a very helpful tool for novice investors. Trading with virtual money is a risk-free approach to test your strategies and gain a better understanding of the dynamics of the market, and these platforms allow you to practice such trading. If their thought is that they are going to somehow outperform the market and pick all of the best stocks, maybe it is a good idea to try some kind of simulator or watch some stocks and see if you could do it, recommends Keedy. If they are going to do this, then you should experiment with it. Spending time with a simulator can help you acquire confidence before investing real money and provide you with insights into how you could react to changes in the market. Number 6. It is important to maintain your dedication to your long-term portfolio. The process of investing ought to be regarded as a long-term operation. If you want to be successful, you need to keep your distance from the daily market news and refrain from any emotional reactions. You can avoid making judgments that are motivated by fear if you reduce the number of times that you review your portfolio. To keep one's attention on long-term objectives and to avoid selling one's portfolio prematurely during periods of volatility, it is helpful to establish a program for frequent portfolio assessments. According to Keedy, some of the news cycles, there are times when it becomes 100% negative and it can become overwhelming for people. The establishment of a disciplined approach to portfolio management will be of assistance to you in accomplishing your own financial goals. Number 7. Begin immediately. Waiting for the ideal time to invest frequently results in the loss of potential chances. It is impossible to pinpoint the perfect moment to begin investing because it is essentially a long-term endeavor. One of the most important things to do when it comes to investing is not just to think about it, but to start doing it, Keedy recommends. The potential of compounding over time can be utilized by beginning investments right now and continuing to make them consistently. To greatly boost your financial growth and assist you in accomplishing your investment objectives, you should consider establishing a savings program that is continuous and investing constantly. Number 8. Don't engage in trading for short periods. Trading on a short-term basis can result in expectations that are not realistic and possible financial losses. According to research, the majority of investors who participate for a short period, such as day traders, tend to lose money because of competition from smart investors and algorithms. Trading regularly means incurring additional expenditures, such as taxes and fees, which might reduce the amount of profit you make. According to Madsen, when I'm advising clients, anything under a couple of years, even sometimes 3 years out, I'm hesitant to take too much market risk with those dollars. This is because I'm concerned about the return on those dollars. When it comes to avoiding the dangers that come with short-term trading, the majority of investors would rather employ a long-term plan. Number 9. Continue to invest over time. A commitment to investing on a regular and continuous basis is required to build genuine wealth. People who are successful financially make consistent contributions to their investments, as opposed to making a single commitment when they are successful financially. Taking this approach demands you to save money methodically and invest a portion of your paycheck consistently. The process of contributing to retirement plans such as 401ks is made easier by the fact that monies are automatically deducted from your paycheck. Even if you do not have a 401k, you may still establish a consistent investment habit by setting up automatic payments to your investment accounts for your retirement savings. Using this continuous investment plan, you will be able to take advantage of the rise of the market as well as compound profits. It is possible that investing in stocks would initially appear to be intimidating. But if you take the appropriate approach, it can be a rewarding method to increase your wealth. You will be able to manage the market with confidence if you direct your attention toward long-term objectives, maintain a diverse portfolio, and continue to educate yourself. Recall that the most important thing is to begin right away and to remain dedicated to your strategy. Investing can, over time, assist you in achieving the financial future that you envisage for yourself. If you found this story eye-opening, don't forget to like, share, and subscribe for more insights and updates. Hit the bell icon so you never miss a video.